All right, let's get right into it. Today, we're digging into a really powerful idea that's at the core of almost every modern financial crisis, something called the Financial Accelerator. We're going to break down exactly what that means and why it matters so much. It's the kind of question that keeps economists and policymakers up at night. How can one little problem, way over in some corner of the financial world, somehow trigger a massive economy-wide collapse? Well, it turns out there's this powerful underlying mechanism that can take a tiny stumble and turn it into an absolute catastrophe. So to really get our heads around this, we've got to start by looking at how markets can get caught in these nasty spirals, where things just go from bad to worse, and they do it with terrifying speed. Yeah, you've probably heard these buzzwords thrown around, right? Especially during big events like the Great Depression or, the 2008 financial crisis. You hear things like financial feedback loops, loan spirals, or the financial accelerator. They're all basically different names for the same scary thing, a dangerous economic domino effect, where one bad thing happens and it just feeds on itself, getting bigger and bigger and bigger. The go-to framework for understanding this is what economists Ben Bernanke and Mark Gertler called the Financial Accelerator back in the late 80s. The whole point of their work was to build a model that explains exactly how these little hiccups in financial markets get amplified, or accelerated, into huge recessions that affect, well, all of us. So, how does this whole accelerator thing actually work? Well, it all starts with a very basic friction in the system. Think of it like a financial speed bump that's just always there whenever someone tries to borrow money. And that speed bump has a fancy name, informational asymmetry. But it's actually a super simple idea. When you go to a bank for a loan, you know way more about your own finances and whether you're really going to pay it back than the bank does. The lender is always at an information disadvantage. So to deal with that risk, to protect themselves, lenders need you to have some skin in the game. It's why you need a down payment to buy a house, or why a business has to put up its factory or its equipment as collateral to get a business loan. It just makes sure that you, the borrower, have something real to lose, which makes the lender feel a whole lot safer. And this brings us to the absolute key. This need for collateral, this need for skin in the game, creates what's called a financing constraint. It puts a hard limit on how much a person or a company can borrow, which in turn limits how much they can invest in their own future. Okay, so what you're seeing here is basically a before and after for a business. On the left, you've got this simple world where a company just decides how much to invest. But on the right, that's the real world. Now, because of that financing constraint we just talked about, the company's ability to invest is suddenly tied directly to the value of its assets. This one little change adds this massive new vulnerability that wasn't there before. And that, right there, is the key to the entire accelerator effect. Okay, so this is where it all comes together. Let's watch how this financing constraint becomes the trigger that kicks the financial accelerator into high gear. So picture this. It all kicks off with a negative shock. It could be anything, really. A sudden panic, maybe the stock market takes an unexpected nosedive. The important part is that the value of a company's assets, its collateral, suddenly drops. And this is that very first domino tipping over. That initial shock to stock returns makes that whole investment demand curve shift to the left. Why? It's simple, really. The value of the company's collateral just went down. That means its financing constraint just got tighter, so it can't borrow as much money to invest in things like new factories or new technology. Investment drops, just like that. And here is where things get really bad, because this kicks off a vicious feedback loop. So the initial shock lowers investment. Okay, but lower investment means lower profits for the company. Lower profits means smaller dividend payments to shareholders. And here's the real kicker. Those dividends are a huge part of what gives a stock its value. So when dividends fall, stock prices fall even more. This makes the original shock worse, which tightens that financing constraint again, which lowers investment again, and the whole cycle just repeats, accelerating the whole economy downwards. This quote from the source material just nails it. That financing constraint, that link between a company's balance sheet and its ability to invest in the real economy, that is the linchpin. If that connection wasn't there, a shock in the stock market would just, stay in the stock market. But because of it, the shock accelerates out into the real world of jobs and production. Okay, so if we know this financing constraint is the bad guy here, the next question is obvious. What can we do to stop the spiral once it starts? And that brings us to how policymakers can try to fight back. The model doesn't just show us the problem, it actually points towards some potential solutions. If the whole issue is that the financing constraint gets way too tight during a crisis, then the fix has to involve loosening it up. The question is, how do you do that? Well, policymakers have basically two main levers they can pull. The first one is to try and increase the leverage ratio. This just means relaxing the rules to let companies borrow more money against the collateral they already have. It's a way to encourage lending when all the private banks are running scared. The second tactic is to go in and directly try to raise asset prices. This is exactly what a program like TARP was trying to do back in 2008. The government comes in as a huge buyer to boost demand, push prices back up, and hopefully restore the value of that collateral for everyone.
Which kind of leaves us with this one big final thought. The ability to borrow against the future is what fuels innovation and economic growth. But what this whole explainer shows is that the very same mechanism, this system built on risk and uncertainty, can become a system's greatest weakness. It really makes you wonder, is the engine of our economy also, by its very design, the instrument of its own destruction?